time. So here is the first trade in delivery inside of the fair value gap. This is the PD array. At 1050, the algorithm will do what? It will seek inefficiency or liquidity. Okay, well, we have a gap. It could act as a breakaway gap. We expect it to trade down into it, but not fill the gap in. Wonderful. What time is that actually occurring? At 1052. Does it meet the criteria for a macro? Yes. So the time this is forming, it meets it. So that means the market should start to gravitate where? To liquidity, here, and where I took you to the daily chart. Because if the market's going to move, it's going to move to something on the daily chart. It's not just 1 minute charts. There's got to be some kind of higher time frame premise. Then if you build that in relationship to what you see on the smaller time frames, you have the best of both worlds. But the inefficiencies on the daily chart, or the stops or liquidity that's being either engineered or engaged, traded to, booked to on the daily chart, all of the things that make the world go round in the financial market, the key premise and levels are going to derive from the daily chart. It's the previous day's high and low, the previous day's high and low in the last 3 days, last week's high and low, the upper quadrant, the midpoint, and the lower quadrant of that range. Those are always the levels that you need to have, and that is not classic support and resistance. Okay, these are reference points that the algorithm will always go back to. I don't give a fuck if you're talking about Forex. I don't care if you're talking about bonds. I don't care if you're talking about gold. I don't care if you're talking about any of the indices, anything. That's what it's going to do. If it's running on an algorithm, those are your key reference points. And you're probably like, man, I can't wait for him to put the recording up so I can rewind that and get that again. It'll be there. But here's the 1050 to 1110 macro. And if you're a first time viewer and you don't know what that means, every single 60-minute interval, okay, every 60 minutes, every hour, okay, at the top of the hour, the market will spool. It means it jumps and runs to one of two things. It will go to a short-term low to tap into liquidity, that it would be sell stops or sell side liquidity, or it goes up to a short-term high, which is buy side liquidity, or engage buy stops for the purpose of introducing liquidity to the marketplace, or it trades to an inefficiency to invite smart money to capitalize on an entry right before price spools to the liquidity. So in case you missed it, the inefficiency I identified as it was forming, I said, I want to see this stay open, and I drew your attention to that volume imbalance on the daily chart. That's all you need for a trade, folks. You don't need to be in it doing all this. You don't need all that. But remember, I was telling you like how it's just going to keep marching around. These are days that you're going to get beat up, and you might know a lot of stuff. You might be a profitable trader, even using other stuff. But when you have these types of days and you're trying to work within it, it can be very frustrating. So if you get one victory, one little win, Caleb, and you identify a day like this and you feel like it's like, man, it's a hard read, take it and leave, and don't regret it. Don't look back. Don't even look back at it. Just shake your feet off, shake the dust off of the trading day, and then leave it. But it's occurring at 1052. It's trading in that inefficiency. For what reason? It's going down there to offer fair value for anyone that understands the elements that I'm teaching you. Then where does the market trade to? Liquidity, which is that high here, because when it drops down here, the highest high prior to that is here. But what's above that? What I took your attention to on the daily chart, that volume imbalance. So from this candle's low, which is 18,931 even, to this candle's high for the buy side, 5150. So we have 21 handles, or no, 20 handles. Okay, 20 handles. That's enough to do a trade for like a bread and butter type set. I can eke 10 to 15 handles out of something like that. Can you? I don't know. But if you're not confident, don't do it. So to give a better range, that volume imbalance that's shaded in yellow that I got on the daily chart, the low of that, and we'll just ballpark it and say it right here, that's 56. So it's 15 handles. Consequent encroachment, eyeball it, 60. So we're looking at 30 handles thereabouts to get to halfway point, which is right up here. And that's exactly what I said. I would only expect that from Caleb. So being a buyer down here, should he have felt inclined to do so, and getting out at midpoint here, and maybe getting filled here eventually, that would be the trade. And then he'd have to move to the sidelines to be content with it.